If you're looking at BMNR, your biggest question is probably this: why buy BMNR at all? Why not just buy Ether directly or buy an ETF? That is exactly what this video is about. I will explain how BMNR shareholders can make money, what extra gains BMNR may offer beyond simple Ether price appreciation, and what extra risks come along with it. Let's be honest, if all you want is clean exposure to Ether, then buying Ether directly is usually the simpler choice. You own the asset itself, you avoid company-specific execution risk, and you do not have to deal with stock dilution, management decisions, or changes in mNAV. BMNR is not just Ether in stock form. It is a company wrapped around an Ether treasury strategy. So the real question is this: are the extra opportunities in BMNR strong enough to justify the extra risks? That is what we will try to answer in this video. One extra way investors may benefit from BMNR is through something called mNAV, which means multiple of net asset value. The idea is actually very simple. You first look at the assets the company holds, value them at current market prices, and then calculate how much that comes to on a per share basis. For example, BMNR currently holds about 4.8 million Ether. If we multiply that by the current Ether price of about $2,355, we get roughly $11.48 billion of Ether value. On top of that, the company also holds some other assets, including Bitcoin, investments, and cash. If we include all of that, the company's total crypto and cash holdings come to about $11.8 billion. Now, if we divide that $11.8 billion by BMNR's total shares outstanding, which are about 537.6 million shares, we get a net asset value per share of about $21.95. The current BMNR share price is about $22.34. So if we divide the share price by the NAV per share, we get an mNAV of about 1.02. Now, if the company's only value was simply the market value of its Ether, then the stock would usually be expected to trade somewhere near an mNAV of 1. But BMNR may also generate value through things like staking, treasury strategy, and access to capital markets. So investors may sometimes be willing to pay a premium over NAV. That is why the mNAV can trade above 1. And this matters because your return does not depend only on whether Ether goes up. It can also depend on whether the stock's mNAV expands. For example, suppose you invest $1,000 when the mNAV is 1.25, and later the mNAV rises to 1.5. Even if the underlying asset value stays the same, your investment would grow to $1,200, which is a 20% gain. Now imagine the underlying asset value also rises 3 times. In that case, your $1,000 would become $3,000, giving you a total return of 200%. But if the mNAV also expands to 1.5, then your investment would instead grow to $3,600, giving you a total return of 260%. That is an extra 60%. So what initially looked like just a 20% extra return ends up creating a much bigger difference over time. So the basic idea is this: many investors prefer to buy shares of a company like BMNR when the share price is low relative to its underlying asset value, especially when mNAV is near or below 1. Because if the asset base grows and the valuation multiple also improves, the returns can compound in a powerful way. Just a quick request: if you are liking the video, please consider subscribing to the channel. It really helps small channels like this grow. Before we move on to the next opportunity BMNR may offer, I want to clear up one common misconception. Will you get the benefit of all the Ether BMNR may buy in the future? Some people say BMNR has around 4.8 million Ether today, and in the future it may have 6 million or maybe even 12 million Ether if it ever reaches something like 10% of supply. And by that time, if Ether's price is much higher than today, then the value creation could be enormous for today's shareholders. But that argument needs a little refinement, because BMNR has already bought today's Ether from the money that has already come into the company. So if BMNR wants to acquire more Ether in the future, where will that money come from? In many cases, not from your original investment. The company may issue new shares, and the Ether purchased with that money, along with the future value created on it, will also belong to the new shareholders. Because as the number of Ether rises, share dilution can also rise. However, that is still not the full story. Even though that is true in an important sense, it is also not completely true to say existing shareholders get no benefit from future Ether purchases. They can still get a portion of that benefit. And this brings us to the next way investors may benefit from BMNR: accretion. So what is accretion? Whenever BMNR issues new shares at a premium, it can still create value for existing shareholders. In simple words, if the company raises money by selling shares at a price above the underlying value of its assets, and then uses that money to buy more Ether, the old shareholders can end up owning more Ether per share than before. That process is called accretion. What is accretion and how does it work? Let's keep the example very simple. Suppose BMNR has 1,000 shares outstanding and owns 1,000 Ether. Let's assume each Ether is worth 1, so the company's total NAV is 1,000. That means each share is backed by 1 Ether. Now suppose the market becomes excited and the stock starts trading at an mNAV of 1.5. In other words, the market is now willing to pay a premium above the company's current net asset value. So what does the company do? It issues 1,000 new shares. Because the stock is trading at an mNAV of 1.5, investors pay $1,500 in total for those shares. The company then uses that $1,500 to buy 1,500 Ether, assuming Ether is still worth 1 in this simple example. Now look at what happened. The company originally had 1,000 Ether. It bought another 1,500 Ether, so now it owns 2,500 Ether in total. And because the total number of shares has increased from 1,000 to 2,000, the new Ether per share becomes 2,500 Ether divided by 2,000 shares equals 1.25 Ether per share. So originally, existing shareholders effectively had 1 Ether per share. Now they have 1.25 Ether per share. That increase from 1.00 to 1.25 is called accretion. And this is one of the key reasons some investors prefer BMNR over simply buying Ether directly. If the company keeps issuing shares above NAV and keeps using those proceeds intelligently, then over time it can increase the amount of Ether backing each share. BMNR itself has described this strategy as accretively acquiring ETH per share, and has said it does not intend to issue equity below mNAV. So who benefits and who does not? The existing shareholders benefit immediately because their Ether per share rises. The new shareholders, however, are paying at a premium. So if they had taken that same money and bought Ether directly, they would have gotten more Ether on day one. In that sense, they are paying up for the structure. But that does not necessarily mean they are making a bad decision. They may be willing to pay that premium because they expect the same process to continue in the future. If BMNR keeps issuing shares accretively, keeps growing Ether per share, and also adds value through staking or treasury strategy, then today's new shareholders may become tomorrow's old shareholders and benefit from future accretion themselves. But wait, that still sounds theoretical. Is accretion actually happening in real life? Well, the numbers suggest that it is. On August 31st, 2025, BMNR reported total Ether holdings of 1.87 million, with 234.7 million shares outstanding. That works out to about 7.99 Ether for every 1,000 shares. Now let's compare that with the latest available figure. On April 12th, 2026, BMNR reported total Ether holdings of 4.87 million, with 537.6 million shares outstanding. That works out to about 9.07 Ether for every 1,000 shares. So what does that mean? It means existing shareholders are now backed by about 13.5% more Ether per share than they were before. Now, on its own, 13.5% may not sound huge at first, but when you combine that with a rising Ether price and potential staking income over time, the effect can become much more powerful. And that is why accretion matters. Another way BMNR may earn revenue is through staking. In simple terms, staking means locking up Ether to help secure the Ethereum network. If you run a validator, your system helps propose and confirm blocks, and in return, you earn more ETH. So you can think of staking like putting up a security bond to participate in the network, except instead of earning interest in dollars, you earn rewards in Ether. Ethereum's official staking model requires 32 Ether to run your own validator. And current benchmark staking yields are roughly in the 2.5 to 3% range, although the exact number changes over time. Cool, so can I do this on my own? Or do I need BMNR for that? Yes, you can do it on your own, but solo staking is not practical for everyone. To run your own validator, you need 32 Ether, which at current prices is about $75,000, plus a reliable always-on setup running Ethereum client software. For most retail investors, that is a big requirement. The other route is pooled staking, where smaller holders combine their Ether through exchanges or staking platforms. That lowers the entry barrier, but it also introduces extra risks like platform fees, custody risk, operational risk, and in some cases, slashing exposure, meaning some Ether is removed as a penalty for not validating correctly. So there are multiple ways to get staking exposure. Some investors may prefer direct staking, some may prefer pooled staking, and some may prefer public market vehicles like BMNR or certain staking-enabled exchange-traded products because they want exposure without running the infrastructure themselves. What makes staking interesting is that the reward is paid in Ether. And this is the part many people overlook. The staking yield is earned in Ether. So if Ether's price rises, the dollar value of that reward rises too. For example, suppose you invest 1,000 into ETH, and over time, the value of that Ether rises 3 times to 3,000. If the staking yield were still around 3%, then you would now be earning roughly 3% on 3,000, not on your original $1,000. In dollar terms, that is like earning 9% on your original cost basis. Now, even if the Ether remains around the same value for a few years, you would still be getting 9% return just from staking. And if Ether one day reached 15,000, as some predict, then the dollar income on your original purchase could look much larger and would near 18% just from staking. So, the appeal is not just the yield itself, it is the fact that the yield is paid on an asset whose price may also appreciate. But now comes the reality check. Time to crush your dreams. That roughly 3% staking return is not fixed. Historically, it has moved around. In March 2023, Ethereum staking APR briefly went above 5.2%. Today, one widely used benchmark shows Ethereum staking yield at about 2.75%. And the reason is simple. The more Ether gets staked across the network, the lower the protocol reward rate tends to be for each validator. Ethereum's official reward illustration shows annual rewards falling from 5.88% at 8 million Ether staked to 4.16% at 16 million, to 2.94% at 32 million, and to 2.08% at 64 million. And the staking base has already grown a lot. CoinGecko reported about 8.8 million Ether staked in 2021. Today, Coinbase's staking page shows around 38.9 million Ether staked. So if institutions, treasury companies like BMNR and other large holders keep accumulating Ether and staking more of it, that would normally increase the total staking base and put downward pressure on the base yield. Can anything offset that? Yes, to some extent. Validator rewards do not come only from base issuance. Validators can also earn priority fees and potentially mEV when they propose blocks. Consider it like a big tip for the validator to do your work early. So, if activity on Ethereum rises and users are willing to pay more to get transactions processed, that can help support validator rewards. But at least for now, the broader effect of more Ether being staked does seem to be compressing the base yield over time. So the big picture is this: staking can absolutely add value, but investors should not assume today's yield will stay the same forever. So if more Ether is staked, wouldn't it mean less Ether for transactions, which would ultimately increase the demand and price of Ether? Well, yes, if more Ether gets staked and Ethereum activity keeps growing, that can support Ether's price because supply becomes tighter and more Ether gets burned. But it is not automatic because staked Ether can later be withdrawn. Liquid staking keeps some of that liquidity alive, and staking also adds new Ether through validator rewards. Although the new Ether will be going back to institutions for restaking. What is burning? So staking is how Ethereum supply increases globally. Similarly, if Ethereum is used in the network, a fee is charged for it, just like Visa may charge for using its card and network. This charge is called burning, which reduces Ether. But the fee is not constant. If there's more demand for tasks in the Ethereum, the per unit cost will go high, so higher would be Ethereum burn. So this staking and burning decides net increase or decrease in Ether globally. That's great. So now I have some understanding of BMNR. But I also understand that BMNR will likely perform better if Ether appreciates in value. So the real question is, will Ether go up? That's a fair question. And to answer it, let me explain Ethereum very briefly. Ethereum, a blockchain ecosystem, and Ether is the token or currency which is used in this ecosystem. Just like Google Play Store, you can say, is a system where its currency is dollars. So if demand for using the Ethereum network goes up, it is likely that Ether's value will also go up. So just like Google Play Store has various apps which can be banks, exchanges, online stores, and others, you can similarly build different apps of all these things called decentralized applications, or dApps. So the basic idea is simple. If more people and institutions use Ethereum, then demand for Ether can also rise. And that is why a good place to start is by asking whether usage of Ethereum is increasing or not. Here are a few points to consider. Active addresses are up strongly year over year. Ethereum daily active addresses at 900,000 presently in 2026, which is up from 438,000 a year earlier. That is a 106% increase in just 1 year. Mainnet transactions recently hit a record. Etherscan's Ethereum daily transactions chart says the highest number of transactions was 3.6 million on April 12, 2026. So even at the mainnet level, usage is still capable of hitting new highs. Stablecoin usage on Ethereum remains huge and is still growing. Ethereum has a stablecoin market cap of $170 billion in April 2026, which was $72 billion in 2023, up by 136%. Not going into the details of what these things are, but the clear picture is that the usage is increasing. So we can hope this will translate into increase in Ether's value as well. What does Ether's price history tell us? Now, of course, no one can reliably predict Ether's capital gains, but what we can do is look at its history to better understand its behavior. Since 2015, Ether has closed higher on about 51% of trading days. And if we zoom out to the monthly level, then since 2017, Ether has closed positive in 55 months, which is about 54% of the time. So at first glance, that tells us something interesting. On any given day or month, Ether does not overwhelmingly move in one direction. It is almost like a coin toss. But here is the important part. Even though the positive versus negative split looks fairly balanced, the actual returns can be extremely uneven. That is because Ether is a highly volatile asset, and a few very strong moves can have a huge impact on long-term return. Just look at the calendar year performance. Ether delivered about positive 399% in 2021, then fell 67.5% in 2022, then rose 90.6% in 2023, followed by 46.1% in 2024, and then about 11% in 2025. So the message is clear. Ether may go up and down almost equally in frequency, but the size of those moves can be dramatically different. Missing the strongest rallies can make a huge difference to your overall outcome. Now, here is another statistic that I find very interesting. If we look at the last 5 years, Ether has remained below $2,000 for about 35% of the days. It has traded between $2,000 and $4,000 for about 58% of the days, and it has stayed above $4,000 for only about 7% of the days. So unless Ether goes into a major breakout phase, history suggests that most of the time it has spent its life below 4,000 and a meaningful amount of time near or below 2,000. That is why, from a trading perspective, one possible way to think about it is this. Accumulation may look more attractive when Ether is near or below 2,000, while profit-taking may become more tempting when it approaches the 4,000 level. What are the other targets of BMNR that can benefit shareholders? BMNR aims to achieve 5% of global Ethereum supply, which they call alchemy of 5%. Tom Lee said that by achieving this, they can issue stock above NAV to increase ETH held per share, issue convertible bonds or warrants using the stocks and ETH's volatility, use staking rewards and operations to buy more ETH, and potentially use stock to acquire other crypto treasury companies. So basically, all those benefits that we discussed above will be exploited better. They also want to build a Made in America validator network. They also launched mAV, which is described as an institutional-grade Ethereum staking platform originally built for BMNR's own treasury, but intended to expand to institutional investors, custodians, and ecosystem partners. The company expects mAV would be the largest Ether staking service provider globally. So when mAV will be used by entities other than BMNR, the shareholders will also get benefit of the profits from this operations. So that's it for today's video. If you found this helpful, do subscribe to the channel. I tried to keep it concise, but these are fairly complex ideas, so if there is any point you feel I should explain better, or if you think I missed something, do share it in the comments. I believe these discussions can help all of us understand the business more clearly. And if you would like me to make a similar video on another company, let me know. Thank you so much for watching, and I will see you in the next one.